You might have heard some politicians, activists, and journalists calling for a higher tax rate on the super rich, or even abolishing billionaires altogether. But what does that really mean? And what would be the consequences of such a radical change? First of all, how many billionaires are there in the US, and how much wealth do they have? According to Forbes, there are 735 billionaires in the US as of 2023, which is the most of any country in the world. The US billionaires are worth a collective $4.5 trillion. The 2023 billionaires are also worth $12.2 trillion, which is $500 billion less than in 2022. That's more than the GDP of Germany, the fourth largest economy in the world. And that's just the billionaires. If we include the centimillionaires, those with a net worth of $100 million or more, the number goes up to 18,600, with a total wealth of $6.1 trillion, according to a report by WealthX. That's a lot of money, right? But how much do these ultra-wealthy people pay in taxes? Well, not much, actually. According to a recent investigation by ProPublica, based on leaked IRS data, the 25 richest Americans paid a true tax rate of just 3.4% between 2014 and 2018, while the average American household paid about 14% in federal taxes. How is that possible? Well, the main reason is that most of their wealth is not in the form of income, but in the form of assets, such as stocks, real estate, or business interests. And these assets are not taxed until they are sold, and even then, they are taxed at a lower rate than ordinary income. For example, a typical taxpayer who bought stock for $10,000 and sold it a year later for $20,000 would pay a capital gains tax of 15%, or $1,500, while a person who held onto it would retain the wealth without having to pay any taxes. In some cases, financial assets passed on to heirs aren't taxed at all because of the stepped-up basis rule. This means that the ultra-rich can accumulate enormous wealth without paying their fair share of taxes, while the rest of us have to work hard and pay taxes on every dollar we earn. This creates a huge gap between the rich and the poor and undermines the principles of democracy and equality. As the famous economist Thomas Piketty wrote in his book, Capital in the 21st Century, when the rate of return on capital exceeds the rate of growth of output and income, as it did in the 19th century and seems quite likely to do again in the 21st, capitalism automatically generates arbitrary and unsustainable inequalities that radically undermine the meritocratic values on which democratic societies are based. So what if we changed the system and made the billionaires pay more in taxes? Well, there are different proposals on how to do that, but one of the most popular ones is the wealth tax, which is a tax on the net worth of individuals above a certain threshold. For example, Senator Elizabeth Warren has proposed a wealth tax of 2% on net worth above $50 million and 3% on net worth above $1 billion. According to her plan, this would raise about $3 trillion over the next decade, while affecting only about 75,000 households, or 0.05% of the population. Sounds fair, right? But what could we do with that money? Well, a lot of things, actually. We could invest in public goods and services that benefit everyone, such as education, healthcare, infrastructure, research, and environmental protection. We could reduce the national debt and the deficit and make the economy more stable and resilient. We could also reduce poverty and inequality and create more opportunities for the middle class and the working poor. We could make America a more prosperous, more just, and more democratic society. Of course, not everyone agrees with this idea. Some critics say that a wealth tax would be unconstitutional, inefficient, and harmful to the economy. They argue that a wealth tax would violate the property rights of the rich, and that it would be difficult to administer and enforce given the complexity and volatility of asset valuation. They also claim that a wealth tax would discourage innovation and entrepreneurship, and that it would drive away capital and talent from the US, leading to lower growth and competitiveness. But these arguments are not very convincing, in my opinion. First of all, there's nothing in the Constitution that prohibits a wealth tax, and in fact, several states already have a form of wealth tax, such as property tax or estate tax. Second, a wealth tax would not be that hard to implement if we had the political will and the resources to do so. We already have the data and the technology to track and measure wealth, and we could design the tax in a way that minimizes loopholes and evasion. Third, a wealth tax would not kill innovation and entrepreneurship, but rather, it would foster them by creating a more level playing field and a more dynamic and diverse economy. And finally, a wealth tax would not make the US less attractive for capital and talent, but rather it would make it more attractive by improving the quality of life and the social mobility of its citizens. If you enjoyed the video, please like this video, subscribe to the channel, and hit the bell icon to get notified of my future uploads. Also, let me know in the comments what you think about this topic and what other topics you want me to cover. I appreciate your feedback and support.